The crypto bull market is delayed.
It's delayed.
The crypto bull market is over.
It's over.
Or the crypto bull market is on schedule but will continue to be Bitcoin only. The consensus view of the crypto market seems to be a mix of these takes. To find out which view is correct, all we need to do is look at the upcoming catalysts, assess whether they could be bullish or bearish, and how that could affect crypto prices. Today, we're going to do exactly that, look at all the macro and crypto catalysts set to occur over the next few months to figure out what comes next for the market. My name is Nick, and this is a video you'll want to watch until the end. Let's start with the macro, and the first macro catalyst to watch is the one that's on everyone's mind, and that's Trump's tariffs. And this catalyst is the primary reason why the prices of most assets, including crypto, have been struggling in recent months. To recap, Trump's tariff threats began at the start of February. These tariff threats hit their apex, though, at the beginning of April, almost exactly 2 months after they started. And if you look at the prices of stocks or cryptos, you can clearly see the crash that occurred during this period. And this begs the question of why assets have crashed so hard. And the short answer is uncertainty. The tariffs have made it difficult for investors to figure out how their investments could be affected. Rather than wait to find out, many have decided to sell and sit on the sidelines until there is more certainty. In other words, most investors have been selling first and asking questions later. The tariffs have also made it difficult for companies and consumers to plan, and as a result, many companies have decided to do things like pause hiring, and many consumers have decided to do things like save money in case they get fired by those aforementioned companies. At the same time, many companies and consumers have been stockpiling goods ahead of the tariffs to minimize the cost they'll have to pay in the future. And this is evidenced by the surge in US imports from China in March and the multiple reports of Americans buying cars ahead of the associated tariffs. Another example is Apple importing a staggering 600,000 kilograms of iPhones earlier this month to avoid Trump's tariffs. That's over 1.3 million pounds for any Americans watching. It stands to reason then that this will be enough iPhone inventory to last Apple for at least a few months, if not longer. This mass stockpiling of inventory could therefore have the paradoxical effect of causing inflation to fall sharply in the short term, especially if the recent drop in consumer sentiment starts to reflect in actual consumption. As basic economics dictates, a greater supply with less demand would mean lower prices. In theory, this is bullish because it would increase the chances that the Fed would lower interest rates to stimulate the economy and juice the markets. In practice, however, it ultimately depends on whether the uncertainty around Trump's tariffs continues, something that the Fed has also underscored as a concern. If uncertainty around tariffs does continue, then investors will continue to sell and sit on the sidelines. Companies will continue to do things like pause hiring. Consumers will continue to save rather than spend. And the Fed won't lower interest rates out of fear that tariffs could lead to higher inflation. The good news is that we're starting to see early signs of capitulation from both the Fed and the Trump administration. A couple of weeks ago, the Fed confirmed that it would step in to support the bond market if there was too much volatility, and the Trump administration has been implementing pauses and exemptions for certain countries and industries. Again, it's been almost 3 months since this all started, and this means that we're hopefully closer to the end of this period of uncertainty than the beginning. But the fact of the matter is that nobody knows for sure. With luck, most of the tariff uncertainty will be gone by the time the current 90-day pause expires, something that's expected to happen by early July. And you can learn more about what's been going on with Trump's tariffs using the link in the description. And while you're down there, if you're enjoying this video so far, why don't you fire up that like button to let us know? And if you're not subscribed to the channel yet, you can do that right now by hitting that subscribe button. You may as well hit the bell as well to make absolutely sure you don't miss our upcoming content. Back to the video. Now, the second macro catalyst to watch is one that everyone has been waiting for, and that is easing by the Fed, be it in the form of lower interest rates or QE. As most of you will know, lower interest rates are bullish because they result in more borrowing, which is the main thing driving the economy and the markets. What you may not know, though, is that quantitative easing, or QE, has a similar effect, and that's because QE is when the Fed buys government bonds, and the more bonds they buy, the higher the bond prices go, and this causes yields on those bonds to fall, which lowers long-term interest rates by extension.
Now it's getting interesting.
Historically speaking, the Fed would only start doing QE after rates were at or close to zero. In recent years, however, the Fed's interest rate policy and balance sheet policy have operated independently, namely with the Fed lowering rates while continuing to do QT. Now, for those unfamiliar, QT stands for quantitative tightening, and it's when the Fed refuses to buy more US bonds after they mature. This lowers demand for US bond prices, which results in lower bond prices, higher bond yields, and higher long-term interest rates by extension. And if you've been keeping up with our coverage of the Fed, you'll know that it basically stopped doing QT in early April when it lowered it down to just $5 billion per month. Meanwhile, the Treasury Department hasn't been able to issue additional bonds because of the debt ceiling being hit in January. This has restricted the supply of new bonds, all while the Fed has increased bond demand by slowing its pace of QT. And when you combine this with the money the Treasury is spending from the Treasury General Account, what you get is an increase in liquidity. In theory, this should be bullish for the markets. In practice, though, it hasn't been, and that's essentially because uncertainty around things like tariffs has resulted in this liquidity flowing into safe assets like gold rather than risk assets like crypto. Again, this will probably continue so long as the tariff uncertainty continues. However, this doesn't change the fact that the macro catalysts related to the Fed are looking better by the day. Now, the fact that the Fed announced that it would stabilize the bond market in the event of volatility effectively confirmed that it will do QE if necessary, and something similar could happen sooner. The Fed's next policy decision will be announced on May 7th, and though investors aren't expecting any rate cuts, the Fed's recent concerns around bond market volatility could result in them stopping doing QT completely, which would be supportive of liquidity conditions around the margins. It's also important to remember that the Fed's most recent interest rate forecast notes that it will be lowering interest rates below 4% by the end of the year. And if inflation comes in lower than expected and the economy continues to weaken in the coming months, the Fed could cut rates even sooner, which would likewise be supportive of liquidity conditions around the margins. And this ties into the third macro catalyst to watch, and that's stimulus coming from other central banks. As some of you may have heard, the Chinese government is reportedly considering pulling forward its stimulus plans to try and offset the effects of Trump's tariffs. Obviously, this would increase liquidity. As some of you may also have heard, Germany is on the brink of spending 500 billion euros on various initiatives, and this spending will reportedly begin in the coming months after the new government has been formed. Of course, this will also increase liquidity. That money will inevitably find its way into the markets. If you need evidence of that, look no further than the reaction from European markets when Germany initially announced this stimulus. They skyrocketed, particularly the companies that will benefit most from this stimulus. Other European countries could announce similar stimulus measures too, and we've covered this in depth in a separate video over here for you, by the way. Now, this relates to the fourth macro catalyst to watch, and that's big announcements related to AI. Believe it or not, but most of the rally we've seen in stocks over the last couple of years has come from a handful of tech companies, and the main reason why these tech companies have been rallying is AI. For context, these companies are Alphabet, aka Google, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. They refer to as the Magnificent Seven, or Mag 7 for short, and account for more than a third of the S&P 500 index and a staggering 45% of the Nasdaq 100 index. They are literally the stock market. And it goes without saying that the crypto market is highly correlated to the stock market. What's fascinating is that many analysts believe the top of the stock market was marked by the launch of DeepSeek, the Chinese open-source AI model that started to gain traction in late January. They believe that the launch of DeepSeek practically showed the world that the Mag 7 were insanely overvalued. Given these facts, it stands to reason that the stock market will rally if the Mag 7 rally, and the Mag 7 will rally if there's some AI-related announcements that prove that DeepSeek isn't the end of the story. At the time of shooting, there are at least 3 catalysts that could meet this criterion in the near term. The first is the launch of OpenAI's GPT-5. Now, to refresh your memory, the launch of ChatGPT in late 2022 was the catalyst that kicked off the biggest rally in the Mag 7 and the rest of the stock market by extension. The launch of GPT-5 could have a similar effect if it gives investors the impression that OpenAI has achieved artificial general intelligence, or AGI, which is what many believe GPT-5 could be close to. There is currently no launch date for GPT-5, but it's expected to be released in the coming months. The second AI catalyst to watch is the release of Tesla's, quote, unsupervised full driving in June, which could be more similar to GPT-5 than you think. And that's because many AI researchers believe that the only way you can have full self-driving is if you have an AI capability that approximates AGI, just like GPT-5 might do. And the third AI catalyst to watch is the one that nobody seems to be paying attention to, and that's an Apple AI. Now, for reference, Apple has been lacking in AI features compared to its peers, and this could change in the coming months now that the company has begun gathering user data for AI training purposes. Other AI catalysts to watch out for are Meta launching AI agents after the recent launch of its Llama 4 model, which is made for AI agents, Amazon working on custom AI chips and data centers, Google potentially launching quantum computing chips for AI, and Microsoft integrating whatever OpenAI launches with GPT-5 due to their close relationship. And that would cover all of the Mag 7 stocks. Now, this pertains to the crypto catalysts to watch, and the first one is one that everyone seems to have forgotten about, and that's the $11.4 billion that will be returned to FTX institutional creditors starting at the end of May. And chances are that some of this capital will find its way back into the crypto market. And this ties into another overlooked catalyst, and that's a surge in DeFi borrowing using less programmable cryptos as collateral, including BTC and XRP. Now, for reference, crypto whales will often borrow stablecoins against their large cap holdings to speculate on other cryptos. Most DeFi borrowing was historically done using more programmable cryptos like Ethereum as collateral. Using less programmable cryptos like Bitcoin as collateral in the past required CeFi lenders like Celsius and BlockFi, which went bankrupt because of all their crypto leverage during the previous crypto bull market. But if you watched our video about wrapped Bitcoin, however, you'll know that the proliferation of new forms of wrapped BTC, such as Coinbase's CBBTC, has made it easier to use BTC as collateral in DeFi. And this sets the stage for significantly more DeFi borrowing against BTC, which could benefit altcoins. And if you've been keeping up with our XRP updates, you'll know that it's in the process of launching an EVM-compatible sidechain that will make it possible for XRP whales to borrow stablecoins against their holdings. Borrowing against BTC and XRP could create tens of billions of dollars of crypto-native liquidity that would find its way into altcoins in connected ecosystems such as Ethereum, Solana, and indeed Cosmos. On that note, the third crypto catalyst to watch is the approval of spot altcoin ETFs. And in case you missed the memo, there are around a dozen spot altcoin ETF applications pending. The recent confirmation of Paul Atkins as the SEC chair could speed up the approvals of these and subsequent applications. And as we've seen with Bitcoin, spot ETFs will make it easier for TradFi liquidity to flow into altcoins, pumping up their prices and boosting their respective ecosystems. These secondary effects of the altcoin ETFs are likewise something that many people seem to have forgotten. Some of these secondary effects are likely to be direct, like increasing the price of SOL, which will likewise cause altcoins on Solana to pump and result in more borrowing against SOL to speculate on other Solana altcoins. Other secondary effects will be indirect, such as speculation that similar cryptos like SUI will be next to get ETFs. Speaking of which, the fourth crypto catalyst to watch is more clarity from the SEC regarding things like NFTs and on-chain activities such as DeFi and airdrops. One thing that we've highlighted in our other videos about the crypto market is how more and more people are engaging with crypto on-chain. Take the Phantom Wallet, for instance. It's crazy to think that it flipped the Coinbase app in app stores last year. It's even crazier when you realize that this happened at a time when there was still lots of restrictions around on-chain activity. Imagine how much crazier it will be when there's clarity. At first glance, you might think that this will require regulations around crypto market structure to be passed by Congress. Upon closer inspection, however, it looks like the crypto market could have next to no restrictions in the interim. Consider the following quote from SEC Commissioner Mark Ueda. Quote, a time-limited conditional exemptive relief framework for registrants and non-registrants could allow for greater innovation with blockchain technology within the United States in the near term. Now, perhaps we're mistaken, but this sounds like there will be virtually no regulation on crypto in the short term. And some would say that Donald Trump launching a meme coin should have made that clear enough. And that reminds me, the fifth crypto catalyst to watch is Congress passing stablecoin regulations, something that could reportedly come as soon as May. And in case you missed the news, mega banks like Bank of America and asset managers like Fidelity are planning on launching stablecoins once this happens, with payment processors like PayPal and crypto companies like Ripple looking to expand their stablecoins too. This will result in a surge in on-chain activity for the networks that support these stablecoins, mainly Ethereum, Solana, and Base. And when you add spot altcoin ETFs into the mix, it's easy to see how the FOMO could take large layer ones like Solana and Ethereum higher despite all of the FUD. Other crypto catalysts to watch include central banks officially adding BTC to their balance sheets, governments accumulating BTC and altcoins through things like staking and mining, and major countries using crypto in international trade. All of the above already seem to be happening to some extent, and the only reason they've had zero impact on prices is because of all the uncertainty around tariffs and macro. Say, if you're planning on trading these crypto catalysts and want to maximize your returns, then check out the Coin Bureau deals page down below, and that's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cash back on deposits of up to 75% on crypto exchanges. You see, these deals, they won't be around for long, so take advantage of them ASAP using the link down below. And this brings me to the big question, and that's what comes next for the crypto market. In the short term, the answer seems to be more uncertainty at the macro level, and this means that we're likely to continue to see more of what we've seen in recent weeks, specifically choppy price action from BTC and larger altcoins, while small altcoins continue to grind lower as retail investors continue throwing in the towel. In the medium term, the answer seems to be volatility in either direction because of the upcoming macro and crypto catalysts, such as the Fed's interest rate decision in early May and stablecoin regulations, which could come later in the month. And these catalysts could be bullish or bearish or neither. The outcome could be another month of chop and grind while investors try to find their footing. By the summer, however, there should be much more clarity on the macro front related to things like tariffs, inflation, and unemployment. If most of the tariffs are settled, inflation is still falling, and unemployment is rising from mild economic weakness, the Fed could respond with big rate cuts. Conversely, if most of the tariffs are still being negotiated, inflation is still sticky, and unemployment isn't showing any signs of deterioration, the Fed could stay put, or it could even raise rates. The former scenario would result in more chop and grind, whereas the latter could result in another big leg lower. But let's say we do get much more clarity on the macro front by the summer. This could create a macro setup similar to what we saw last autumn when the Fed was cutting rates out of caution in response to falling inflation and rising unemployment. What followed was a multi-month rally in the markets. As we learned, there are lots of catalysts that could incentivize capital to flow into stocks and cryptos against this accommodative macro backdrop. However, it's worth keeping in mind that these macro and crypto catalysts could be delayed by market participants if the macro backdrop isn't accommodative enough, and I'll reiterate that there's no guarantee we'll see such conditions. But if we do and we start to see a recovery sometime over the summer, this could result in investors doubling down on both asset classes going into the autumn. And that's simply because the end of the year has historically been a very bullish period for stocks and crypto. Many crypto investors would likely interpret the rally over the summer as being the lead up to the classical cycle top rally in the autumn. However, there is a risk that the macro conditions could be deteriorating again by that point. And that's because there's a risk that the finalized tariffs will cause inflation that starts to feed into the economy. And you'll recall this effect may not be felt at first due to all the inventory stockpiling in recent months. If the economy is still weak or getting weaker, we could end up in a stagflationary recession that central banks and governments will have a hard time getting out of. And if you want to know what that could mean for the economy, well, you can check out our video on that right over here. And if you're not subscribed to the channel yet, well, you can do that right over here. That's me for now. Thank you very much for watching, and I'll see you again soon.